Good morning, everyone, and welcome to our discussion on the autumn budget today. We have an expert panel here from Creston Reeves to highlight the key implications, provide insight and guidance, and answer your questions following Wednesday's announcements. So to introduce myself, I'm Rachel Emerson, one of the partners at Creston Reeves, and I'll be chairing our session today. I'd like to start by saying how delighted we are to have so many of you join us this morning. I think we've got a record number of attendees today, which really does show how big this budget was. For those of you who don't know Creston Reeves, we are here to help our clients with so much more than just accounting, business and wealth advice. We support you in achieving your ambitions so that you can reach your brighter future, which is exactly why we host these sorts of webinars to help you with any questions that you might have. So if I can start with some housekeeping. This webinar is being recorded and a recording will be sent to you all later today. IT permitting, we'll be asking for a bit of interaction by taking some polls throughout the webinar so we can share the results with you and generate some further discussion. There will be a pop-up survey at the end of our session today, and we'd be really grateful if you could just spare a couple of minutes to provide us with some feedback. So we've already had some questions sent in, but please do continue to submit your questions throughout the session by using the question functionality shown on screen now. I'll leave that there for just a moment whilst you familiarise yourself with that function. So after months of speculation, the first female Chancellor in our history delivered the first Labour budget in 14 years. It was badged as a budget to fix the foundations of our economy and emphasise stability and the need to invest, invest, invest. A return to the old Labour approach of tax and spend, some might say. So before we dig into the top implications for individuals and businesses from Wednesday, we want to hear your initial thoughts on what was announced. So we have our first poll question for you, which you should see on your screen now. So the question is, how do you feel about the changes in the autumn budget? Are you very positive, neutral, negative, or very negative? So I'll just leave that there for a little bit so as many of you as possible can answer, and then we will have a look at what the results are. Okay, so I'm definitely not surprised by these results. I think 36% of you, the highest percentage, albeit not by much, are neutral, and I think that's kind of echoes the conversations I've been having with colleagues and clients over the last 24 hours or so. I mean, a lot is mentioned in the budget, and it can be quite bamboozling with the words that are said, and really the devil is in the detail, and until we get into that detail we don't actually know how it's going to affect us. So hopefully that's what we're going to do today for you. So for those of you that watched the announcements on Wednesday, it was its usual rowdy affair, and I think we can all agree that Rachel Reeves managed to hold her own, albeit a very long speech, which actually I think lost the majority of the audience towards the end. It was a budget focused around fixing broken finances and public services, with details on the £22 billion black hole left by the previous government and the investment plans for schools and the NHS. This budget came with huge anticipation, with months of speculation and scaremongering in the press. Many predictions set a worst-case scenario for capital gains tax hikes and the current lucrative pension reliefs being removed. And although increases to capital gains were announced, those were perhaps not quite as aggressive as we first predicted. And pensions remain mostly out of the budget, which is, I'm sure, a welcome relief to many. There were some winners, and I'm positive we will all agree that there was a welcome change and good news for the carers amongst us. And the 1p saving on a pint at the pub could have been the highlight of the budget, but the cost of employing someone to actually pour it for you will now certainly remove any scope for that enjoyment. As in all budgets, there are losers, and it is clear that it is the businesses and the wealthy that are to shoulder the majority of this £40 billion tax raising measures announced. The big ticket items for the day were most certainly the changes to inheritance tax, stamp duty, and employers' national insurance contributions, and we'll be covering these in more detail today for you. Some might say a politically clever budget, but is it really one that is going to deliver the growth that the UK so desperately needs? Given the OBR has marginally downgraded growth forecasts for the duration of this term, what does this mean for the engine room of our economy, the SMEs and entrepreneurs? Whilst we all know that investment is urgently needed in our public services, do we really feel that these tax measures will balance the books for the investment needed? And more importantly, will it encourage the private sector to invest as well? So now let's take a look at how some of the media responded to the budget and the headlines from yesterday morning to give a flavour of the wider reaction to the measures that have been announced. The Guardian held the return of the tax and spend regime on its front page as the Chancellor raised spending by £70 billion a year over the next 5 years. The Mirror focused on the spending on public services as Labour plans to rebuild Britain. The Financial Times commented on the Chancellor's plans aimed to fix broken finances, citing that this is the biggest tax rise since the 90s. But her vow to protect workers could be hit if businesses reduce headcounts or pass on lower pay rises. The Eye shared a watchdog's view that the national insurance burden on businesses will hit jobs and that it is businesses that are bearing the brunt of this landmark tax rise. The Daily Mail stated that Britain's growth prospects took a dive as tax on businesses is at its highest and the relaxation of borrowing rules will just lead to a massive spending spree. The Sun kicked off the first of the Halloween references yesterday, celebrating the Chancellor freezing fuel duty in her budget. And if you haven't seen that front page where Rachel Reeves's face is superimposed onto a pumpkin, it might be worth a Google today to bring a smile to your face. The Telegraph does the same, saying that the budget will damage living standards with a nightmare on Downing Street. The Daily Express said the £40 billion tax raid on the nation's purse was a Halloween shocker of a budget, and families are hammered and businesses are battered. And finally, the Star chose not to focus its front page on the budget at all, instead opting for the more pressing matter that apparently ghosts are dying out as fewer sightings are being reported these days. So now it's time for me to introduce our panel of experts today who will be delving into the detail of the budget and discussing Wednesday's announcements with us. So we have Daniel Grange, who is partner and head of tax and capital taxes expert. We have Sam Jones, who is a corporate tax partner, and Sam specialises in corporate reorganisations, share schemes and R&D. Tom Boniface is a private client tax partner and head of our global mobility sector. Andrew Tate is our restructuring partner and head of advisory at Creston Reeves. And we have Terry Bergam, who is from Creston Reeves Financial Services and is a chartered financial planner. So, were there any rabbits out of the hat from Wednesday, or more important fiscal details that were just glossed over in the Chancellor's speech? First, I will hand over to Daniel Grange, who will be summarising the top implications for individuals.
Thank you, Rachel, and good morning, everybody. So after months of speculation, on Wednesday, we finally got to hear the changes that are being made to the tax rules that affect individuals. And despite all the speculation that we heard before the budget, there were many things that weren't changed. And those include the rates of tax on both earned and investment income, the 7-year rule for gifts to be exempt from inheritance tax, the tax relief available on pension contributions, and the ability to take a tax-free lump sum from most pensions. The big changes are to capital taxes, so capital gains tax and inheritance tax, which are generally paid by wealthier individuals, and so in the government's view aligns with the pre-election statement that those with the broadest shoulders should carry more of the tax burden. So what were the top implications for individuals? So the non-dom tax status is going to be abolished from April next year and will be replaced by new rules that use residency-based tests instead. The remittance basis will be abolished and replaced with something called the foreign income and gains regime. There'll be a temporary repatriation facility for funds that are currently offshore, and there'll be new inheritance tax rules that will also be based on residency rather than domicile. There's certainly going to be some complexity around these new rules, but the inheritance tax rules will provide greater certainty to those coming to or leaving the UK. I think it's interesting that despite the politics that surrounds non-DOMs, the government's own figures suggest that the changes to the income and gains rules will only affect about 35,000 people a year. Tom, who leads our global mobility team, will be on hand to answer any questions that come in on this area. So moving now on to the main capital taxes changes. As I mentioned earlier, there's no change to the 7-year gifting rule for inheritance tax, and the thresholds have now been frozen until 2030. But significant changes were made to inheritance tax, both to the reliefs available on agricultural and business assets and the inheritance tax status of pension schemes. So at the moment, most pension schemes are exempt from inheritance tax, and over recent years, this has led to more people using pension schemes as an estate planning vehicle, using them as a way to pass on value and wealth to future generations, rather than just using them to provide for their own retirement. And this is what the government has said it's trying to counter. From April 2027, so about 2.5 years away, the value of almost all unused pension funds will be combined with the rest of an individual's estate, and depending on the combined value, potentially be subject to inheritance tax. Any amounts left to a surviving spouse will benefit from the spouse exemption in the same way, or in the normal way. If IHT is payable on the pension fund will pay it, and then the post-tax amount will then be available for distribution to beneficiaries. The income tax treatment of any distribution that's made from the pension fund to a beneficiary will then depend on whether the individual was under or over 75 when they pass away. And this single change will bring far more estates within the scope of inheritance tax, and for those with unused pension funds, potentially increase the IHT liability of those already subject to tax. The other major change announced to IHT was to reliefs that are incredibly valuable to many of our clients. So these are business property relief and agricultural property relief. As things stand today, BPR and APR can give unlimited 100% relief from IHT on qualifying business and agricultural assets. So that includes shares in unquoted trading companies, so perhaps your own personal trading company, a partnership or sole trade business, and land and buildings that are used for the purposes of agriculture. There's also a 50% relief, which most commonly applies where you own assets personally and they're used in a trading company that you control or by a partnership in which you're a partner. But from April 2026, so we have 18 months or so until the new rules are fully implemented, APR and BPR will no longer be unlimited. There will be 100% relief on the first £1 million of value, and then 50% relief on the value over £1 million. So giving an effective rate of inheritance tax of 20% on this excess value. So this table shows the potential impact of the changes on the IHT that would be payable on business or agricultural values, depending on the value of them. These changes will have a really significant impact on succession planning for family businesses and farms, and in many situations it will make it more difficult to pass on those farms and businesses down the generations intact on death, particularly where they are asset rich but cash poor, so there aren't the cash proceeds or there isn't the cash available to pay that inheritance tax. Our initial view, less than 48 hours after the budget, is that this may make lifetime succession planning more attractive than holding on to assets and then passing them on death. But this does come with capital gains tax considerations and anti-avoidance rules around inheritance tax that also need to be borne in mind. So we'll need to wait and see what detail comes out following the consultation that's being launched early in the new year. Shares on more minor stock exchanges, so for example the AIM market, that currently benefit from 100% relief will only qualify for 50% and won't be included within that £1 million limit that I talked about earlier. The changes to APR and BPR, when combined with the introduction of IHT on pensions, represents a really significant change in the IHT landscape and how best to structure your affairs to mitigate your potential inheritance tax exposure. The government's figures suggest that 6% of estates are currently subject to IHT, and this is likely to increase to around 10% once these changes have been implemented. As more detail on how these rules are going to be implemented is released, we would recommend that you review your potential inheritance tax exposure, the way your business is owned and operated and structured, the potential of making lifetime gifts, your pension nomination forms, and the structure of your wills, all with a view to minimising the tax that will be payable on your death. Moving away from inheritance tax, there are also changes to the rates of capital gains tax, some of which apply immediately, so affecting disposals made on or after budget day, and other changes that are being phased in over a period of time. So before the budget, there were different rates of capital gains tax that applied to residential properties and other assets. And the image on the screen shows the changes in rates over the coming years, with the figures in red being the tax increases. So for disposals on or after budget day, there's now a single set of rates that applies to all assets except something called carried interests. So we're now looking at 18% capital gains tax for gains falling within the basic rate of income tax when combined with your income, and a 24% rate for gains that fall into the higher or additional rate bands. We have a tax relief called business asset disposal relief, what you may think of as entrepreneurs relief, and this gives a reduced rate of tax on qualifying gains of up to £1 million during a person's lifetime. The current rate of tax on qualifying disposals is 10%, and this remains the case until the 5th of April 2025. And due to the increase in the rate of the main rate of CGT, this business asset disposal relief, BADR, is now worth up to £140,000 per individual, but only for the next 5 months until we get to the new tax year. The rate of tax on BADR qualifying gains then increases to 14% for the 25-26 tax year and increases again to 18% from the 6th of April 2026 onwards. And any gain over that £1 million lifetime allowance will now be taxed at the new main rate of 24%. So if you're thinking of selling your business, it'll be really important to think about the timing of the disposal to minimise the tax that will be payable on the gain that you realise. There are lots more details to consider from the budget for individuals, particularly around the inheritance tax changes, and I'm sure we'll cover at least some of these during the Q&A session. And I'll now hand back to Rachel.
Many thanks, Dan. I think there's a lot there actually, and I think what I jotted down a couple of notes, and I think the key takeaways are Succession planning is definitely got to be on people's radar going forward following this budget and planning for the future. And also just that careful planning for disposals over the next couple of years to make sure that people are doing it in the most tax efficient way. So definitely reach out to the team here at Creston Reeves if you've got any questions around that. So if Daniel's presentation has raised any questions, please do remember to use the question function and we will pick up as many of these as possible in the panel discussion part of the webinar at the end. So we now have our second poll question for you, which you should see on your screen now. Which of the personal tax changes will impact you the most? Is it capital gains tax, inheritance tax, the non-dom changes, stamp duty land tax, or VAT on private school changes? I'll just leave that there for a second and get as many of you to answer as possible. And let's see what the results show. Well, that's huge. A huge 50% of the audience today are concerned, or maybe not concerned, but are thinking there's going to be a big impact from the inheritance tax changes. So certainly watch out for any articles or newsletters that Creston Reeves publish over the coming weeks, as these will be quite insightful to you. So next, to summarise the top implications for businesses, I will pass you over to Sam Jones.
Thank you for the introduction, Rachel. So there are 5 main areas impacting businesses that I'm planning to cover today. The first is the increase in employers' national insurance, which will result in businesses bearing the brunt of the budget tax hikes. The OBR have estimated that 25 billion per year will be raised from this change alone, being nearly 2/3 of the increase in taxes. To alleviate the impact on smaller businesses, there has been an increase in the employment allowance. The change to the employers' and national insurance would appear to impact larger businesses more so than smaller ones, with the increase in the employment allowance expected to mean that approximately 865,000 employers will not pay employers' NI, and more than half of employers with NIC liabilities no worse off in the next tax year. There has also been significant increases in the national minimum and living wage, which will also impact businesses. All these changes will be introduced from April 2025. We feel these changes will disproportionately impact those businesses with high staff numbers, but a low average wage, such as the hospitality and leisure industry. It is expected that working people will ultimately feel the hit of these changes by seeing a reduction in future pay increases, and businesses will ultimately need to pass on the additional costs by raising prices. A welcome relief was that there were no changes to the current corporate tax regime, with tax rates and capital allowances staying the same for the duration of Parliament. A corporate tax roadmap has been released, which details future consultations and the government's objective to build stability and certainty for companies operating here. There were some minor changes to be aware of, such as the 1.5% increase to HMRC's late payment interest, with the aim to encourage businesses to pay their taxes on time. Also, some additional anti-avoidance measures were introduced to close loopholes in the tax rules for those trying to avoid the Section 455 charge. And there were changes to strengthen the employee ownership trust framework. Let's look at the employer changes in a little more detail. There were 3 main changes impacting all employers. Firstly, from April 2025, there will be an increase in the employer's national insurance contributions from 13.8% to 15%. In addition, the secondary threshold is being cut from £9,100 to just £5,000. This threshold is the point at which employers begin to pay employers' NIC, and remember, there is no upper limit. Just a decrease in the secondary threshold alone will cost employers £615 per employee. As mentioned, to counteract the increased NIC costs for smaller businesses, there will be an increase in the employment allowance to £10,500. The allowance is currently just £5,000. This increase will offset employer NIC liabilities and effectively reduce an employer's NIC liability by this amount. There will be a relaxation in the eligibility rules so that larger businesses with employers NIC in excess of £100,000 in the previous tax year will now be able to claim the allowance. The rules for group and connected companies are here to stay, meaning only one company will be able to claim the allowance. Overall, these changes mean that a business employing an employee at the average UK wage of £36,000 would pay an additional £938 per annum in employers' NIC. So let's look at this in a little more detail. The increase in the employment allowance will only be a saving where a business employs 6 or less employees at this level. After that, there will definitely be an increase in the total NICs payable by the employer. Unfortunately, unincorporated businesses will feel these changes disproportionately to companies. Companies were previously suffering employers' NIC at 13.8% with a CT saving at 19%. When you compare this to a new 15% NIC rate and an increased CT rate of 25%, the effective post-tax rates are similar, being 11.18% against 11.25%. Will we see an increase in businesses opting for contract labour to avoid the NIC hike? Moving on to the national minimum and living wage. There is a 6.7% increase in the national living wage, increasing to £12.21. Meanwhile, the national minimum wage for 18 to 20-year-olds will be hiked from £8.60 to £10 an hour. That's a 16.3% rise, being the biggest rate increase on record. Let's move on to look at the corporate tax roadmap. As mentioned, there weren't any significant changes announced affecting corporate tax. However, the government has released a corporate tax roadmap which sets out its commitments during Parliament. The aim is to provide predictability, stability and certainty to businesses and investors, with the aim of retaining and attracting companies to the UK. The government has committed to maintaining the headline rate of corporation tax at 25%, remaining the most competitive in the G7, maintaining the small profits rate and marginal relief at their current rates and thresholds. They will continue to monitor international developments with a view to ensuring that the UK's tax regime remains competitive. There are similar commitments for capital allowances. Full expensing relief is here to stay. It may even be extended to provide relief for leased assets, which are currently excluded. There will be no changes to the £1 million annual investment allowance, the rates for the writing down allowance, and no changes to structures and buildings allowance. There is also a commitment to provide greater clarity on what expenditure qualifies for the various capital allowances by simplifying the capital allowances legislation. After so many changes to the R&D regimes over previous budgets, there is welcome news that the rates for the merged R&D expenditure credit and the SME R&D intensive scheme will remain as previously announced. There's a continued commitment to enhancing the administration of R&D reliefs. This will include establishing the R&D Expert Advisory Panel, continuing to improve signposting and guidance on R&D reliefs, and launching an R&D disclosure facility by the end of 2024. There will also be a consultation on widening the use of the R&D advance assurance. The patent box regime will remain, which provides an effective 10% tax rate for exploiting qualifying IP. They will also retain the UK's competitive regime for intangible fixed assets. There are various consultations to be released within the international tax realm. A consultation in spring 2025 will look at lowering the transfer pricing exemption thresholds to bring medium-sized businesses into the transfer pricing regime, while retaining an exemption for small businesses. The government will consult further in spring 2025 on the reforms regarding rules on transfer pricing, permanent establishments and diverted profits tax, and will look at introducing a requirement for multinationals to report cross-border related party transactions to HMRC. The government will continue to support the OECD recommendations of implementing Pillar 1 and Pillar 2. Even though there were no changes to CT, there is certainty to the regime, allowing businesses to plan for the future. So that's all from me, and I will hand back to Rachel for our final poll.
Thank you very much, Sam. I mean, a lot there. I think some of the things that I took from that, and actually I was quite astounded by, was 2/3 of that, of the £40 billion tax raising measures, are going to be covered by businesses. So 2/3, that's huge. And certainly I felt, and I know when I heard the announcements, I definitely had that feel for those certain sectors. Certainly in hospitality and leisure, are really, and caring really, are really going to start feeling that, and actually that's going to show in the end user and the cost that we all have to pay. And also I just picked up right at the end there about cross-border transactions reporting. I mean, that sounds like that's going to be fun, and maybe quite complex, so watch this space on that. So as Sam said, we're now on to our third and final poll question, which you should see on your screen now, and this is for the business owners on the webinar today. So in light of the changes, what is the main priority for your business over the next 3 to 6 months? Is it growing your business, sustaining your business, business survival, selling or exiting, or anything else? And actually what I'd like to do at this juncture is ask if I can welcome all of our experts onto the screen, because actually I think this would be a good opportunity for Andrew Tate, our Head of Advisory, to reflect on the results of this poll. Over to you, Andrew.
Great, thank you. What an interesting poll, an interesting question. So growing your business, sustaining your business, very pleasingly, is at the top there, and that is actually typical of Creston Reeves clients, which is fantastic to see. Our clients are very diligent about making sure their businesses are healthy. I think sustaining your business, I think, has been referred to, that actually the impact of these national insurance changes and other business tax changes will need to be built into strategy to make sure that businesses can sustain and grow. There will definitely have to be a close look at margins, and what we're hearing is that business owners will have to look at overheads, how wage increases will come through, and obviously bearing in mind that other businesses will also be looking at these measures. So we may find price increases coming through, both from suppliers as well.
Yeah, that makes complete sense, Andrew, actually, and many thanks for that. So now we're on to our Q&A part of the webinar, and your questions have been coming in thick and fast, but please do continue to submit these, and we will leave this how to ask a question functionality on the screen throughout the discussion. So if we're not able to answer all of your questions today, because we are limited on time, then we will answer them after the webinar. So please do pop your questions in there and we will come back to you. So I'm now referring to my amazing team behind the scenes who are collating all of the questions, and I have some questions coming through. So I have my first question from Jennifer, and I'm going to direct this to you, Tom, actually, because the question is, how will the budget affect my current non-DOMS planning to return to the UK in April 2025. Let me read that again because I fumbled over my words there. So how will the budget affect currently non-DOMs planning to return to the UK in April 2025?
Thanks, Rachel. It's nice that the 1% of the 420 got to the top of the queue there on the questions, so that's nice to see. I think the key thing is scrap the idea of non-domicile. That's the key takeaway. Domicile is removed for tax purposes. Still exists in a legal framework, but it's no longer there for tax purposes. Only consider residency and non-UK residency as your starting point. The rules aren't too dissimilar to what we were told in spring. The devil was in the detail, which we didn't get in the last Tory government, and the Labour budget provided that detail. Initially, we thought that the removal, essentially, of the remittance basis regime would simplify things, particularly for the first 4 years for a lot of individuals coming to the UK. Based on what I've seen, I actually don't think it's too much of a simplification. actually. People who have used the remittance basis over the last few decades will know that it comes with an onus on record keeping and maintaining offshore statuses with your transactions and your bank accounts. These new rules also require a lot of reporting. So whilst there's some significant benefits in the first 4 years for people who haven't been UK resident for 10 years, very key, because that could be returning British people or people coming to the UK for the first time, there is some significant benefits on bringing money to the UK and spending money in the UK for the first 4 years, which hopefully will stimulate growth. But actually, the key part is there is still some significant record keeping and filing responsibilities that will be required. So it's not a case of ticking a box and it being simple. It's a case of actually there's some significant work needed for those clients wanting to make use of the new regime.
Okay, thanks, Tom. So I think in answer to Jennifer's question, how will it affect currently non-DOMs returning to the UK, it is going to affect you. So get the advice that you need because the rules are changing and they are still quite complex. So certainly reach out to your advisor. Okay, thanks, Tom. I'm going on to my next one, which is from Peter. And the question is, how do I save my farm to pass it on to my children? And this might be one for you, Daniel.
Yep, happy to pick that one up, Rachel. Thank you very much. Peter, thank you for your question. It's really difficult to give generic answers to specific questions, and it really will depend on your circumstances and position. As I outlined earlier, the rules don't affect people where the value of their business or the farm is less than £1 million. I appreciate that's unlikely if you've got a farm here in the southeast, and any value over and above £1 million will effectively be subject to an inheritance tax rate of 20%. Something that I think is worth remembering that people aren't aware of or forget is that generally inheritance tax on land and buildings, including farms, could be paid over 10 years. So it's not something that needs to be paid immediately, sort of 6 months after death, like most inheritance tax is payable. So that buys a bit more time to fund the inheritance tax on farms and other land and buildings. I think, as I said in my presentation, I think we will see more people thinking about lifetime succession planning, so handing on assets during their lifetime rather than waiting until death and passing those assets on. Potentially that can be done with no inheritance tax if you gift the asset and then live for 7 years. So that works from an inheritance tax point of view, but there are some wider tax things to think about. So that transfer will be potentially subject to capital gains tax, although there may be some reliefs available there. And there's also then the practical question of, if it's your business and that's your livelihood, how do you maintain your income and your living standards? And there are some anti-avoidance rules to think about called gift with reservation of benefit. So I think there are some options. As I said, I think we'll see more lifetime succession planning rather than holding on to assets until death. But it really does depend on your personal circumstances and whether you can afford to pass those assets on during your lifetime.
Yeah, thanks, Dan. I think the key takeaway for everybody, thank you, Peter, for your question, is actually it's very bespoke. Any of the answers to these type of questions, we need to understand all sorts of things and your appetite and what you want for your family and future and things going on in the future. So each solution will be bespoke to you. So I'll move swiftly on, and I've got another Peter, whether it's the same Peter or not, I don't know, but Peter has asked, should I now be drawing money from my pension instead of my investment savings? And I think, Terry, this might be one for you.
Thanks, Rachel. So yes, I mean, this is quite a complex area because it will depend on your own personal tax position and the structure of your investments and pensions that you have, but it's definitely something you should now be looking at. I think there's a clear need to think about spending pension tax-free cash if you haven't already drawn that, as that's a tax-free part of your pension you can take. Of course, if you draw down further funds from your pension, then they will be taxable within your lifetime. So I think it's really looking at what the sort of trade-off between the lifetime benefit and the death benefits and what your own personal priorities are. But it's definitely something you should be discussing with your advisor and looking at your next sort of review.
Yeah,
Rachel,
thanks,
can I
Terry.
just jump in there?
Yeah, of course you can, Dan.
I think the other thing to remember is that pension fund or pension funds are still really tax efficient from an income and capital gains tax perspective. So they continue to grow income and capital gains tax free. Whereas if you take money out of your pension and then pushed into normal investments, then that will then become taxable as well. So it's not just the inheritance tax that we need to be thinking about, but it's also the tax on the investment returns that are being generated.
Thank you. So I think, Peter, in response to your question, is there's not one right answer as to whether you should be taking money from your pensions over your savings. So it's talk to the right people. Okay, I'll go on to my next question. I've got a question from James. Interesting point about CT and how it can mitigate the employer's national insurance rise. Sadly, as a charity, this does not benefit us. Is there any crumb of comfort for charities in the budget that was glossed over? I don't know whether this is one for you, Sam, or if anybody else on the panel would like to pick up as well.
I think that's probably one for me. So generally, charities don't pay corporation tax as long as they're working on doing things for their charitable objectives, etc. They don't pay tax on any sort of gains that they make. So therefore, the cost of the increase in employers' NI will just be another cost to the charity. Unfortunately, there weren't any sort of significant tax breaks or anything for charities announced in today's budget. So we're just dealing with the normal tax rules. So therefore, yeah, another industry that's going to be hit by the employers' NIC hit will be charities and those in the non-taxable sectors.
Yeah, which is a shame, isn't it? Thanks for that, Sam, and I hope that answers some of your question there, James. Okay, I've got another question. This could be a quick answer from Daniel, if I may. It's a question from Jessica, and she has said, sorry if I missed this, are there any changes to personal capital gains taxation, not business?
So yes, absolutely there were. So there were some immediate changes to the rates of capital gains tax that individuals pay. So for disposals on or after Wednesday, the rates are going from 10% for basic rate taxpayers and 20% for higher and additional rate taxpayers to 18 and 24% respectively. And then the rate of business asset disposal relief, which is paid by individuals but on qualifying gains, stays at 10% for now, goes up to 14% from next April, and then up to 18% from April 2026. So yes, absolutely, capital gains tax changes for individuals.
Okay, fabulous. Thank you. I hope that clarifies that for you, Jessica. I have a question from Chris, and it says, will the BADR increase impact EMI options held for more than 2 years but disposed after 5 April 2025? So Sam, is that one for you?
Yeah, that's one for me. So share schemes, so if you hold a qualifying EMI option, as long as you've held that option for 2 years, you will qualify for business asset disposal relief at the point of sale of those shares. So currently the rate of BADR will be whatever the rate is at the point of that disposal. So those employees holding those EMI shares will also be hit by the increase in BADR from 10 to 14 and then 18%. So they're not as tax advantageous as they were previously. However, there's still a significant tax saving from any sort of unapproved scheme. So they're definitely still worth using as a way of remunerating and incentivizing your employees.
Brilliant. Thank you, Sam. Next question. I mean, the questions are coming in thick and fast, guys. Thank you very much. So I've got a question from Mike. Do the changes to inheritance tax just impact estates that hold agriculture or business property? So Tom, do you want to give this one a go?
Yeah, I can jump in there because from my sort of global mobility angle, the inheritance tax changes also impact non-domiciles. Again, remove that terminology from your phrase books for tax. Previously, a non-domiciled person, their non-UK situs assets be outside the scope of UK inheritance tax. That changed once an individual was here for 15 years. And those rules have essentially changed to meaning that once they've been in the UK for 10 years, their non-UK situs assets will be in the scope of UK inheritance tax. What it could also mean is people who were born in Britain, who previously would have retained their domicile throughout their lifetime, they may benefit from this legislation once they've left the UK for 10 years. So there's going to be people who weren't born here brought in to inheritance tax before they normally would have, and there's a tail if they leave. There is a welcome tapering of that tail. So once you've been here for 20 years, you have to be gone for 10. If you've been here for 13 years, for example, you have to be gone for 3. So there's a benefit that we didn't see previously, announced previously by the Conservative government. But certainly risk for people who have come to the UK in being brought inside the scope of IHT sooner, but actually benefits for British people who have been outside the UK for more than 10 years, and their non-UK situs assets being outside the scope of IHT moving forwards. So good and bad.
Yeah, no, I can hear that. So absolutely, there's many angles that can affect inheritance tax. So it's really important that you've got somebody who can see all of those angles and pull all of that together for you. I have a question. I think this goes to Terry. I'd be interested, this is from Tom, I'd be interested to know if pensions are to be bought inside the inheritance tax regime, would withdrawals on beneficiary / successor pensions still be subject to income tax at the beneficiary's marginal rate when death occurs post 75? That sounds quite techie, Terry, but if you need me to repeat it, let me know.
Yeah, so this is in relation to the lump sum and death benefit allowance that replaced the lifetime allowance earlier this year. So my understanding is that effectively there's no changes to the lump sum and death benefit allowance. So once inheritance tax has been levied on a pension fund, then the income tax treatment of the payments paid out to the beneficiaries will still depend on whether the pension member died before 75 or after 75. So if they have died after 75, then the beneficiaries would still be liable to income tax at the highest marginal rate when they draw benefits, as is the current position. So no change on that as far as my understanding goes.
Okay, that's actually quite helpful. Thank you, Terry. Okay, I have a question from Michael, who has said, in your IHT chart, this is probably to you, Daniel, now, you were showing the value of business at maybe 10 million and a relief of 1 million, i.e. 10%. But does it not go with the shareholders' value, i.e. 2 shareholders will get 1 million each, etc.?
Yes, so the example that was up on screen was showing the value attributable to an individual and therefore their personal inheritance tax position. So on that example of 10 million, if I own 100% of a company that's worth 10 million, the first £1 million would be exempt, and then the next 9 million I'd get 50% relief on. So 4.5 million would be exempt from inheritance tax. The next 4.5 million would be taxed at 40%. So it's looked at on an individual by individual basis based on the person who's died, not on the people or the number of people that have received the shares. So it's that £1 million is applied to each estate, and that's the total between agricultural and business assets.
Brilliant, thank you. Okay, we've got a question from Rosie, and it says, with staff on the minimum wage and monthly dividends as a form of income only, how does the budget affect this? So that might be one for you, Sam, from a business perspective, and perhaps Andrew can talk about jump in and talk about how business owners might start remunerating themselves, or what that looks like for business owners, because are they actually workers?
Yep, that's fine. So yeah, if you've got minimum wage employees, obviously you're going to see a big increase in your salary costs, because you've got to be meeting the new national living wage or national minimum wage. The national living wage is optional for businesses and not everybody takes that up. So you do have to make sure that your employees are paying the national minimum wage. With the reduction in that secondary threshold for employers' NI, you're going to have to pay more employers' NI. So ultimately, as a business, you're going to have less money left in the pot as profits available for you to pay out as dividends. So that sort of mix between what you take and what's left will change. I'll hand over to Andrew.
I think I haven't really got a great deal to add to that, Sam. I think the point about dividends and making sure that dividends are properly documented on a monthly basis is really, really vital. So I think that I don't think there's a great deal of change to that regime, but I think the impact on profits and making sure that they're absolutely identified is really important.
Thank you very much. I mean, we've had a couple of questions, and if I group them together, it's about, obviously these changes have come in. What do the panel think about any future changes? I mean, this is the first budget of a 5-year term. What feeling have you got about what the Chancellor might say in future budgets? Can you foresee any more changes in national insurance?
National insurance is a tricky one, because obviously the Conservative government reduced employees' NI quite considerably, and obviously we've just seen this huge hike. I wonder if it's something they might actually leave alone for a period of time. I mean, can it go much higher? Possibly. I wonder if they might start dabbling around the edge of some of the other taxes that we see and reliefs that were available to businesses.
Has anybody else got any comments?
I can jump in on sort of, again, the non-dom work. There were big changes in 2009 in how the remittance basis works. There were big changes in 2017 in terms of bringing much more people in the scope of worldwide UK income and capital gains tax. And now we've seen these significant changes in 2024. What we see at each time is they do like to let the dust settle and see how that has impacted behaviours in taxpayers. Will there be people leaving? Will more people come to the UK to make use of the new regime? So I don't foresee any changes in that area in this Parliament, unless it really does show that actually a lot of wealthy people left and will happily pay tax elsewhere. Then they might be reactive, but I think we'll see, at least for 5 years, if there's any changes in that area, given what we've known over time.
I think that's a really interesting point, actually. It's about, will this budget change behaviours, and is it enough to change behaviours? We'll just have to see. I do have another question from Heather. What sectors will benefit from lower business rates, and what are the rules? Now, Andrew, is this one you could pick up for us?
Yeah, I just thought it might be useful to add a bit of commentary here. The sectors which really are going to be looked after, or the government is trying to look after, is retail, hospitality and leisure. And obviously with the employers' national insurance changes, those are the businesses which will probably suffer from those as well, having and also the minimum wage changes. So the government is bringing in some further help for those businesses. It's not immediate. It's going to be in a couple of years' time, and effectively, it's looking at actually how the multiplier that is applied to those businesses when it comes to paying business rates is put in. So I think probably the mechanics of it are probably sort of for individual businesses, and perhaps a bit too detailed to go into here, but there is certainly going to be help, but it's not immediate.
Yeah, I understand that, and it's a lot to do with local authorities as well and how quick they respond, which we all know can be a little bit of a pain. But I suppose the positive is that there will be something on the horizon for those sectors that we can all understand are going to be feeling this quite a lot.
Yeah.
I have probably a quick one for you, Dan. We've got a question from Daria. Does the capital gains on your main home remain at 0?
In really simple terms, yes. But as always, it depends on assuming you've lived there as your main residence throughout your period of ownership and those bits and pieces. But yes, there's been no change to the main residence relief rules.
Brilliant. Thank you very much. Right, everybody, I think I would just like to say a huge thank you to all of the questions, from the live questions and our pre-questions from our attendees today at the webinar, and also to our panelists for your insightful answers. Unfortunately, we have run out of time on today's webinar for any more questions. And we have had so many come through, and I can understand why, because there's a lot of discussion points and how might this impact, etc. So I can assure you that if you have asked a question and we haven't been able to answer it live today on the webinar, that one of our experts will come back to you and answer your question. And if there are any additional questions or matters that you would like to discuss with our team, then please leave a brief description of these on the pop-up survey that's going to come up at the end of the webinar, and we will also follow up with you on those as well. So please do complete the very short feedback survey at the end, so we can continue to improve these webinars and events for you going forward. We truly do value and listen to your feedback, and we want them to be as useful to you as possible. So please do leave that feedback. And whether you're already a client working with us or not, if anything has come out of today that you'd like to discuss any further, then please do not hesitate to contact us, and we'd be delighted to hear from you. If I can end on a sentiment gauging the general feel of Wednesday's budget announcements and the conversations that I've had and today's sort of questions that we've had, it would be that many of us do not resent the need to pay tax. We appreciate there's a problem, but only if it really is being used to invest in those public sectors and improve the poor service that is just no longer acceptable. And only time will tell whether this is the budget that will deliver on that promise. And that leaves me to say thank you very much for joining us, and enjoy the rest of your day.